China has unveiled a massive $1.4 trillion debt package designed to bolster its economy over 5 years. The plan, announced by Finance Minister Lan Fan, involves regional governments borrowing up to $6 trillion, $838 billion, over the next 3 years to replace their hidden debt. This hidden debt, typically owed by risky local government financing platforms, has been a major source of concern for China's economic stability. The $10 trillion $1.4 trillion debt swap program aims to refinance swapping out hidden debt for local government bonds. The government has raised the debt ceiling for local governments for the first time since 2015, marking the first time since 2015 that they have done so mid-year. Local governments will also have access to a separate $4 trillion $558 billion quota for special local bonds over the next 5 years. This move is aimed at further reducing their debt holdings and providing much-needed relief to struggling local authorities. The announcement of this enormous debt package came at the conclusion of a 5-day meeting of the Standing Committee of the National People's Congress, NPC. China's top legislative body, the NPC, is taking serious steps to address the country's economic challenges head-on. The answer lies in the country's recent economic woes, which have been exacerbated by years of tight pandemic restrictions and a crippling real estate crisis since the beginning of 2023. Central and local fiscal revenues have fallen short of expectations, leaving local government coffers drained and authorities across the country struggling with mountains of debt and few resources to kickstart economic growth. Finance Minister Lan Fan revealed the staggering scale of China's hidden debt problem, which stood at $14.3 trillion $1.99 trillion at the end of 2023. The government's goal is to slash this amount to $2.3 trillion $320 billion by 2028, an ambitious target that will require significant effort and resources. While some analysts see the debt package as a step in the right direction, others remain skeptical about its effectiveness. The policy goal is to achieve the GDP growth target and reduce tail risks rather than to meaningfully boost the economy. The details of the debt swap and policy move were described by Finance Minister L. Fer at a news conference. China's leader Xi Jinping recently announced a much-needed stimulus package in late September, primarily focused on monetary measures. Economists have been anticipating additional stimulus measures worth up to $10 trillion to restore confidence in the world's second-largest economy. The plan aims to repair municipal balance sheets as a longer-term objective, and Finance Minister Lan Fan has hinted that more stimulus is on the horizon. Under a second Trump administration, the International Monetary Fund estimates that hidden debts amounted to a staggering $60 trillion or 47.6% of GDP at the end of 2023. China puts the figure at a lower $14.3 trillion. The debt swaps are expected to save local governments $600 billion in interest payments over the next 5 years, providing some much-needed breathing room. Finance Minister Lan Fan reiterated additional support measures such as policies to support state sector purchases of unsold apartments, reclaiming undeveloped residential land from developers, and replenishing the capital of big state banks. However, he did not provide details on the size or timing of these more direct stimulus measures, leaving many investors and analysts guessing that because of this refinancing of the debt, local governments would be able to spend it. Many economists argue that stronger consumer stimulus is desperately needed to revive China's economy. The country faces tariffs on its exports from the US and other nations, low wages, high youth unemployment, and a weak social safety net keep household spending low. China's household spending is below 40% of its GDP, a full 20 percentage points below the global average. Policymakers may be holding back some stimulus, waiting for more clarity on Trump's China policies before making any bold moves. They may also want to avoid the appearance of overreacting to the US election. Market reactions to China's debt package announcement have been mixed, with some investors disappointed by the lack of details on additional fiscal spending to directly stimulate the economy. Beijing has a fundamental opposition to handing out cash, stating they don't like welfarism and adding that Chinese officials believe it would encourage people to become lazy investors. Analysts are now closely watching for the December Politburo meeting and the Central Economic Work Conference, where greater clarity on the U.S. trade stance and China's fiscal strategy is expected. China's debt package, which aims to refinance $10 trillion for local governments, has been met with criticism from Beijing due to its focus on supply-side measures rather than boosting domestic demand. Critics argue that this approach may exacerbate industrial overcapacity and trade tensions, as producers cannot absorb inventory during export shocks, which would hurt profits, revenues, and private investment. Some argue that direct household income support is needed to boost consumer spending and sentiment, while debt swaps do not address the underlying local fiscal revenue shortfalls, meaning local governments will still need to borrow to fund basic operations. Victor Shaw, a specialist in Chinese politics and finance at the University of California, San Diego, warns that the stimulus package will not address the problem in a meaningful way. He also notes that the stimulus package is smaller than some expectations, especially considering the tariff risks posed by Trump at around 0.5% of GDP per year. Carlos Casanova, Asia's senior economist at UBP, estimates that China needs closer to $23 trillion to reduce housing inventory and hidden debts. The money is largely used for infrastructure and property rather than direct household support. Many analysts believe that managing market expectations is a top priority for the government, with several press conferences hosted by government officials sending positive signals to the market. The second priority is to reduce systematic risk in the banking sector and among local governments. The property market is also important, as they see deflation pressure coming from the property sector. Dealing with the deflation cycle to change people's expectations about future inflation and accelerate their spending decisions is another priority. China's $10 trillion debt refinancing package for local governments caught the U.S. off guard, but many analysts believe it falls short of the fiscal firepower needed to reinvigorate the sluggish economy, particularly in terms of spurring consumer demand. With the risk of a renewed trade war under a second Trump administration, Beijing may be holding some stimulus measures in reserve, waiting to see how the geopolitical landscape unfolds. After 4 years out of the Oval Office, President Trump is returning to face an emboldened, stronger China. This is likely one of Trump's primary plot lines in the sequel to his first 4-year showdown with China. One of the biggest concerns for China is Trump's campaign pledge to impose tariffs of over 60% on Chinese imports, which would be a devastating blow to the world's second-largest economy. The country is already grappling with high youth unemployment, a prolonged property market slump, and mounting government debt. A recent analysis by UBS suggests that a 60% duty on Chinese goods could shave off as much as 2.5 percentage points, or around half of China's projected economic growth. China's export-driven economy has been a crucial engine of growth, and any disruption to this engine could have far-reaching consequences. As a result, Chinese factories have been rushing to front-load their exports in anticipation of these potential tariffs. In October 2024, China's exports grew at the fastest pace in over 2 years, surging by 12.7% year-on-year and blowing past expectations. This surge was driven by factories scrambling to ship products to major markets including the US and the European Union before the threat of a two-front trade war materialized. China's exports to the US increased by an annual 8.1% last month, while outbound shipment to Europe jumped 12.7% over the same period. Zichen Hang, a China economist at Capital Economics, expects shipments to stay strong in the coming months. Any potential drag from Trump tariffs may not materialize until the second half of next year. Trump's return could create a short-term boost to Chinese exports as U.S. importers increase their purchases to get ahead of the tariffs. However, the surge in exports is not without its challenges. Trade data from South Korea and Taiwan pointed to cooling global demand, while German manufacturers have reported they are struggling to find buyers overseas. Analysts conclude that Chinese producers are slashing prices to offload stock, particularly in the face of slowing sales in key markets such as Europe. During Trump's first term, his administration implemented policies to control high-tech exports from the U.S. and its allies to China, including banning the sale of components to Chinese tech giants like Huawei and restricting China's access to advanced semiconductors. These measures have forced China to become more self-reliant and invest heavily in its own domestic R&D and scientific capabilities. China has made significant strides in various high-tech sectors, but the cross-applied application of technology is what really worries DC. China's market share of many high-tech exports, particularly electric vehicles, EVs, is growing despite U.S. tariffs and restrictions on access to technology. The Sovereign Wealth Fund explains that the shift in U.S.-China tech rivalry was triggered by Trump's ban on the sale of components to Chinese telecommunications firm ZTE in 2018. This move was seen as a defensive move from China, which had been pushing China to build up critical industries like AI and space. As a result, China has gone from having 4 government procurement projects worth over $1.4 million replacing foreign hardware and software with domestic alternatives 8 years ago to 169 such projects this year. However, chip makers still feel the tightening of these Chinese companies, as they cannot supply to global clients and can't have access to the latest chips. Winston Ma Nashik-Nakar, a former Commerce Department official under Trump, expects the president-elect to be more aggressive about export control policies towards China, anticipating a significant expansion of the entity list that restricts exports to those on it. The coming years are the most critical for this U.S.-China tech rivalry. Trump has previously criticized the Biden administration's CHIPS and Science Act, which earmarked $53 billion to boost domestic semiconductor manufacturing. He has also accused Taiwan of stealing the chip industry from the U.S. decades ago. This suggests that the president-elect may seek to undermine or even dismantle this initiative, which could have significant implications for the global semiconductor supply chain. Trump has expressed concerns about the potential security risks posed by Chinese-made EVs and the data they could collect on American consumers. In his second term, he may try to fulfill a campaign pledge to protect U.S. carmakers by imposing even higher tariffs on Chinese EV imports in an effort to avoid U.S. tariffs. Chinese companies have been taking various measures, including shifting production and operations to Mexico. In 2023, an estimated $3.7 billion of Chinese foreign direct investment was made in Mexico, significantly higher than previous decades. This trend allows Chinese producers to circumvent tariffs by swapping a Made in China label for a Made in Mexico one as long as the products undergo substantial transformation. U.S. Customs and Border Protection closely inspects the origin of goods, looking at where the product was made and the final point of manufacture. If an officer notices an irregularity, the truck could be sent for an X-ray exam or have its cargo offloaded for further inspection. Chinese companies are seeking new export markets outside the U.S. to offset the potential impact of tariffs. The north part of Mexico is being invaded with foreign investment, with people coming from Asia, Europe, South America, and Africa to build plants and manufacturing facilities to enter the United States market. However, experts warn that if new tariffs are imposed on Chinese goods, it would thwart the plan of these Chinese companies to backdoor their way into the U.S. through the USMCA agreement. This would have a huge impact on those companies, specifically according to Jordan Dart. Other headwinds facing companies investing in Mexico include security worker availability, water scarcity, and Mexico's economic policies. The biggest threat to the nearshoring boom politics is tariffs. If tariffs are placed on Chinese goods, it would absolutely thwart the plan of these Chinese companies to backdoor their way into the U.S. through the USMCA agreement. China has also been preparing to buffer its economy against the potential impact of fresh tariffs. Analysts expect Beijing to deliver a mix of monetary and fiscal stimulus measures, including subsidies and funding support to offset the tariff effects. However, a scholar at the Roger Rotnam School of International Studies in Singapore warned that the Chinese economy might require even more stimulus than the $1.4 trillion package expected on Friday, which will be a serious blow to China's international trade that will affect jobs and government revenues. The impact of potential U.S. tariffs on Chinese imports would not only affect China-American consumers and businesses but also affect the price of a wide range of goods. With Donald Trump's return to the White House, many things are going to change, especially the price of everyday items. The president-elect made several promises regarding tariffs on foreign-made goods, specifically Trump's recent announcement that there would be tariffs of at least 25% on goods made in Mexico. The European Union voted to impose tariffs of up to 45% on Chinese-made electric vehicles, pushing relations between the two economic superpowers to the brink of a full-blown trade war. E-cars from China are flooding the European market, and the EU claims this is neither fair nor legal. They want to impose a tariff of 48% on e-cars from China, saying this will protect the European car market. Europe is following the USA's example, which recently quadrupled tariffs on Chinese electric vehicles to 100%.